The dollar is in danger. Global markets are sounding an alarm that too many people are still ignoring. When a currency that has anchored the global financial system for nearly 8 decades begins to show structural cracks, it is not merely a market fluctuation. It is a signal, a warning that the world is entering a new monetary era. The sharp decline of the dollar this year is not random. Markets are forward looking, and they are pricing in something deeper, the erosion of confidence. The U.S. is facing an unprecedented combination of high debt, slowing growth, shifting geopolitical alliances, and a Federal Reserve transitioning from tightening to easing. When yields fall, when deficits rise, when political polarization pushes policy into uncertainty, the world naturally reassesses where it wants to store long-term value. That reassessment is happening in real time. Central banks are diversifying reserves, nations are exploring alternatives for trade settlement, investors are increasingly shifting to innovation-driven and decentralized assets that cannot be printed, devalued, or manipulated easily. This is not de-dollarization driven by ideology, it is driven by math, by data, and by risk management. The global economy is simply adjusting to a future in which no single currency can dominate unchallenged. The fascinating part is how quickly the narrative has shifted. For years, analysts assumed the dollar's strength was inevitable, an iron law of modern economics, but history rarely respects certainty. Technological disruption, geopolitical realignments, and demographic trends have a way of rewriting the rules faster than institutions can adapt. The U.S. is no longer the sole engine of global innovation. Capital is now global, mobile, and increasingly digital. Markets reward agility, efficiency, and trust, not legacy dominance. When the dollar weakens, it exposes vulnerabilities that were always there: the fragility of debt-driven growth, the risks of financing massive obligations with a currency that is losing its premium, and the challenge of maintaining global leadership while facing internal economic contradictions. And yet, within that challenge lies extraordinary opportunity. The world tends to innovate the most when old systems weaken. New financial rails, new asset classes, and new models of value transfer emerge when traditional structures lose their grip. That is exactly what we are witnessing. The decline of the dollar is not simply a crisis. It is an inflection point, a moment in which investors must decide whether they want to cling to the illusions of permanence or position themselves for the next era of global finance. Historically, transitions like this shift wealth on a massive scale. Those who anticipate them benefit. Those who dismiss them are left wondering what happened. The truth is, the world is not abandoning the dollar because it wants to, it is doing so because it must. The global economy is diversifying, decentralizing, and digitizing. A system built around one currency, one government, and one central authority cannot efficiently support a world defined by exponential technological change. We are moving from a centralized financial architecture to a networked one, from slow, analog, paper-driven settlement to real-time, digital, borderless value exchange. The dollar will not disappear, but its role will evolve. Its dominance will diminish as new alternatives rise, as innovation reshapes global finance, and as markets recognize that the future belongs to systems that are transparent, efficient, and unconstrained by political cycles. This shift is not a threat, it is a transformation, and those who understand it early will have the chance to build, invest, and position themselves for the opportunities that only emerge when a global paradigm changes. The U.S. dollar collapse warning is no longer a distant scenario, it is a conversation that global markets are having quietly but urgently. The greenback, once considered the bedrock of stability, is showing signs of strain. Investors, central banks, and policymakers are all watching, and the signals are clear: something big is coming. The decline of the dollar this year is not an accident. It is a reflection of a deep structural shift in global economics. For decades, the dollar benefited from being the world's primary reserve currency. That dominance allowed the U.S. to finance massive deficits and debt at relatively low cost. But that era is changing. Inflation pressures are easing, growth is slowing, and the Federal Reserve is signaling a shift toward lower rates. With yields declining, the advantage of holding dollar-denominated assets diminishes, and the logic that once kept the dollar strong is weakening. Simultaneously, global dynamics are evolving in ways that were once unimaginable. Countries are diversifying reserves, seeking alternatives to the dollar in trade, and exploring digital and decentralized financial systems. This is not a political statement, it is a practical response to risk. When trust in a single currency becomes vulnerable, the world naturally seeks balance. The dollar's declining share in global reserves is a visible manifestation of that trend. Debt and fiscal strain compound the problem. The U.S. government continues to run large deficits, and national debt is approaching levels that challenge long-term sustainability. While historically the dollar has been insulated by global confidence, that trust is being tested. Investors are increasingly questioning whether a system built on perpetual borrowing can continue indefinitely without significant consequences. Markets respond to uncertainty, and when uncertainty rises, capital begins to flow elsewhere. Technology and innovation are also reshaping the financial landscape. Capital is no longer constrained by borders. Digital currencies, blockchain-based assets, and fintech platforms offer alternatives that are faster, more transparent, and more resilient than traditional systems. The dominance of any single fiat currency becomes harder to maintain in an environment where global liquidity is mobile and instant. The world is moving toward a more multipolar financial system, one where adaptability and technological integration matter as much as size or legacy status. The implications are enormous. A weakening dollar affects everything from trade to inflation to investment returns. Commodity prices, corporate earnings, and sovereign debt obligations are all denominated in dollars, and shifts in the currency ripple across the globe. Yet within this challenge lies extraordinary opportunity. Financial history shows that periods of currency transition often coincide with transformative innovation, wealth redistribution, and new investment frontiers. Those who recognize the trends early position themselves advantageously. Those who dismiss them are exposed to risk. It is essential to understand that this is not merely a cyclical issue, it is structural. The dollar's role as the undisputed global reserve currency is being redefined. Its dominance is being challenged not by a single event, but by a convergence of economic, political, and technological forces. The question is no longer whether the dollar will face pressure, but how markets, businesses, and individuals respond to this new reality. The collapse warning is a call to attention, not panic. The dollar will remain relevant, but its influence will be more contested. The shift is already underway, and the speed of adaptation will determine who benefits. Those who embrace innovation, diversification, and global perspective will thrive. Those who cling to old assumptions risk being unprepared for a financial world that is evolving faster than conventional wisdom predicts. The warning is clear: the era of automatic dollar dominance is ending, and something big is coming. The end of dollar dominance is no longer a theory, it is an unfolding reality. For decades, the U.S. dollar has served as the anchor of the global financial system, a symbol of stability and trust. But 2025 is revealing cracks that were long hidden, and the implications are profound. Global markets are signaling a shift, and the warning signs cannot be ignored. This is not about panic, it is about recognition. The dollar's strength has always relied on confidence in U.S. institutions, fiscal discipline, and global leadership, but that confidence is being tested. The Federal Reserve is moving from tightening to easing, global interest rates are converging, and U.S. debt levels are at unprecedented highs. When the yields that once attracted global capital begin to diminish, the incentives to hold the dollar weaken, and the mechanics that sustained its dominance are challenged. At the same time, central banks around the world are quietly but steadily diversifying. They are reducing exposure to dollar reserves, exploring alternatives in euros, yuan, and increasingly in digital and blockchain-based financial instruments. This is not driven by ideology, it is driven by necessity. When a single currency carries structural risk, risk management demands diversification. The era of unquestioned reliance on the greenback is drawing to a close. Global trade is also adapting. Emerging markets, particularly in Asia and the Middle East, are negotiating agreements that bypass the dollar, leveraging local currencies and digital settlement platforms. This structural shift in trade flows signals a fundamental rethinking of the global financial order. Capital is mobile, information is instantaneous, and innovation is relentless. The systems that worked for the 20th century are being replaced by networks that are more resilient, decentralized, and technologically integrated. The consequences are broad and interconnected. A weakening dollar has ripple effects on commodity prices, corporate earnings, and debt obligations globally. Inflationary pressures, cross-border investment, and multinational balance sheets are all sensitive to these changes. Yet, within disruption lies opportunity. History shows that periods of currency redefinition coincide with technological breakthroughs, new asset classes, and significant wealth creation. Those who understand the trend early and position themselves accordingly gain a strategic advantage. What makes 2025 extraordinary is the convergence of multiple forces. Economic, political, and technological shifts are accelerating the transition from a unipolar currency system to a multipolar one. The dollar will not disappear, but its monopoly over global trade and reserves is diminishing. Markets are adapting faster than many governments or institutions, and those who fail to recognize this evolution risk being caught unprepared. The end of dominance does not mean collapse, it means transformation. The financial ecosystem is becoming more balanced, competitive, and innovative. Investors are no longer restricted by borders or legacy systems. They are exploring new frontiers. Digital assets, decentralized finance, and global portfolios designed to weather volatility. This is a structural realignment, a fundamental recalibration of trust, value, and influence. In essence, 2025 is marking a historic shift. The dollar's era of uncontested supremacy is ending, and a new financial architecture is emerging. Those who understand the trends, embrace innovation, and diversify wisely will thrive in this environment. Those who remain anchored to the old assumptions may find themselves exposed to risks that were once unimaginable. The warning is clear: global finance is entering a transformative period, and the end of dollar dominance is just the beginning of a larger evolution. The dollar crisis has begun, and what the mainstream media isn't telling you is that this is not a temporary blip, it is a structural shift. For decades, the greenback has been the cornerstone of global finance, a symbol of trust, stability, and power. But 2025 is proving that no system, no matter how dominant, is immune to pressure when the underlying fundamentals change. The decline in confidence is clear. The U.S. dollar index has weakened sharply this year, reflecting a growing skepticism from investors and nations alike. Central banks are reassessing their dollar holdings. Global trade is increasingly conducted in alternative currencies, and digital financial innovations are beginning to circumvent traditional channels. This is not a fringe movement, it is a fundamental rethinking of how the world stores and transfers value. The root causes are multiple and interconnected. First, the U.S. is running structural deficits that are unprecedented in peacetime, and debt levels are approaching unsustainable heights. Second, the Federal Reserve is shifting monetary policy in response to slowing growth and lower inflation, eroding the interest rate advantage that has historically underpinned the dollar's strength. Third, Geopolitical tensions and trade realignments are prompting nations to diversify their financial dependencies. Taken together, these forces create a scenario where the dollar is no longer the automatic safe haven it once was. Technology and innovation amplify these shifts. The rise of blockchain, digital currencies, and decentralized finance is providing alternatives that were unimaginable just a few years ago. Capital is now global, instantaneous, and increasingly immune to the constraints of legacy systems. As markets embrace speed, transparency, and efficiency, reliance on a single fiat currency becomes a liability rather than a convenience. The ripple effects are enormous. A weaker dollar increases the cost of imports, affects commodity prices, and influences corporate earnings globally. Sovereign debt denominated in dollars becomes more challenging to service. Inflationary pressures may rise in unexpected ways, and investors who remain overly concentrated in traditional U.S. assets may find their exposure riskier than they realize. Yet, embedded within this challenge lies unprecedented opportunity. Financial history shows that periods of disruption, when old systems weaken, are the very moments when innovation, new asset classes, and transformative wealth creation accelerate. What makes this crisis particularly significant is its structural nature. Unlike previous cyclical downturns, this is a convergence of fiscal, monetary, geopolitical, and technological forces that is fundamentally reshaping global finance. The dollar will not disappear, but its dominance is being questioned, and the global financial order is evolving toward a more multipolar system. Investors who anticipate this evolution can position themselves advantageously. Those who ignore it risk being unprepared for the next wave of global economic change. The crisis also underscores a broader truth: trust in currency is fragile. The strength of money is not measured solely by its purchasing power at a moment in time, but by the confidence that people and nations place in it over the long term. When trust erodes, alternatives emerge, and those alternatives, increasingly digital, decentralized, and globally accessible, are moving into the mainstream. We are at a pivotal moment. The dollar crisis is not simply about currency fluctuations, it is about the recalibration of global finance. The forces reshaping the dollar's role are unstoppable, and the world is entering a period of transformation in which old assumptions no longer apply. For those who recognize the trends early, who embrace innovation and diversification, and who understand the structural shifts underway, this crisis is not just a warning, it is an opportunity to participate in the next era of global wealth creation. The dollar crisis has begun, and the question is whether we will respond with insight or remain anchored to outdated paradigms.